January 15th, 2026. In a sterile office in Lower Manhattan, the gatekeepers of global capital are about to sign a document that could erase $8.8 billion in market value with a single stroke. For 5 years, Michael Saylor has been playing a high-stakes game of financial engineering that most people called a genius infinite money glitch. He turned a stagnant software company into a $60 billion Bitcoin battery powered by billions of dollars in zero-interest debt. But as the sun sets on 2025, the battery is showing signs of structural failure. The death spiral, a catastrophic feedback loop that forces a company to liquidate its own treasure, is no longer a theoretical ghost. It's a mechanical certainty if the stock drops just a few more percentage points. And the clock is ticking. To understand why MicroStrategy is currently 2026's biggest financial risk, you have to understand the glitch. Back in 2020, Michael Saylor realized something that changed the history of the Nasdaq. He realized that as long as his stock traded at a premium to the Bitcoin he owned, he could print money forever. The math was simple, yet terrifyingly effective. If MicroStrategy owned $1 worth of Bitcoin, but the stock market valued that Bitcoin at $2, Saylor had a 2 times mNAV premium. He could issue $1 billion in new stock, sell it to investors at that $2 valuation, and immediately go out and buy $1 billion worth of actual Bitcoin. Because he was selling overvalued stock to buy undervalued assets, the amount of Bitcoin backing every single share actually went up. Existing shareholders didn't just get diluted, they got accreted. It was a perpetual motion machine that institutional banks were more than happy to fuel. Hedge funds lined up to give Saylor billions of dollars at a 0% interest rate. They weren't looking for a yield, they were looking for an equity option disguised as a bond. And for a while, the strategy worked perfectly. But the physics of finance have a nasty habit of reasserting themselves. The machine only runs as long as the market is willing to pay $2 for $1 of Bitcoin. If that premium vanishes, the flywheel doesn't just stop, it reverses. And as the calendar turns to early 2026, the first cracks in the reactor are finally becoming visible to the naked eye. A company presents to the market with a $60 billion Bitcoin stack, but only $1.44 billion in its cash breakwater. Management calls it a battery. Critics call it a countdown. To the aspiring entrepreneur, this is the most critical lesson in liquidity management. You can be the richest person in the world on paper, but if you can't pay your electric bill in cash, you're insolvent. As of late 2025, MicroStrategy's annual dollar obligations have reached a staggering $571 million. This is the hard interest on billions in debt, plus the dividends for a dizzying array of preferred stocks. Stocks with names like STRK, STRF, and STRE, Strike, Strife, and Stream. Those aren't just cool tickers. They are martial instruments designed to capture volatility. But they come with a price. Every single year, $571 million must leave the company's treasury just to keep the lights on and the creditors quiet. With a $1.44 billion reserve, the math is cold and unforgiving. The company has exactly 2.5 years, about 30 months of total runway before the cash runs dry. Michael Saylor claims a 21-month runway to be conservative, building a psychological buffer for the market. But this assumes a crypto winter, where Bitcoin stays stagnant or drops. In a world of $80,000 Bitcoin, the interest isn't the problem. The problem is the wall of 2028. In September of that year, a $1.01 billion debt bill comes due in one single lump sum. If the cash pile is spent servicing dividends by then, and the stock is trading at a discount, MicroStrategy can't just roll the debt. They would have to find $1 billion in a market that no longer believes in the glitch. And that is when the board is forced to look at the one button they promised they'd never touch. In the fine print of the Series A perpetual preferred stock filings, there is a legal clause that serves as Saylor's ultimate get-out-of-jail-free card. It's called the PIK Toggle, payment in kind. It means that if MicroStrategy runs out of cash to pay that $571 million annual bill, they don't have to sell their Bitcoin. They can simply choose to pay their investors in MSTR stock instead of dollars. On paper, this creates an infinite runway. The company can theoretically never go bankrupt as long as it can print new shares to satisfy its obligations. But for the aspiring entrepreneur, there is no such thing as a free lunch. Paying in stock is a polite way of saying massive dilution. Every time the PIK toggle is flicked, the amount of Bitcoin backing each share of MSTR drops. The digital gold per share starts to bleed away. This works fine when the stock is at a 2x premium because you're printing expensive paper to protect cheap Bitcoin. But remember that January 15th deadline? If the MSCI excludes MicroStrategy from the global indices, billions of dollars in passive capital will be forced to sell. The premium could evaporate instantly, sending the mNAV below 1.0. If the stock is at a discount, printing more shares to pay dividends is like trying to put out a fire with gasoline. You are diluting your shareholders at the exact moment they are already fleeing. This is the hidden trapdoor. It preserves the corporate shell, but it destroys the value of the stock, and it sets the stage for the final mechanical failure, the death spiral itself. It starts with a flicker on a screen and ends with a historic liquidation. This is the clinical anatomy of the death spiral. Phase 1 is the catalyst. It's January 2026 and the MSCI decision finally drops. MicroStrategy is excluded from the global indices. A massive wave of mandatory selling hits the stock. For the first time in years, the stock price crashes harder than Bitcoin itself. The premium to net asset value, the mNAV, flips from a 1.2 times premium to a 0.8 times discount. This is the inversion point. Suddenly, the infinite money glitch isn't just broken, it's a liability. Phase 2 is the arbitrage attack. Those hedge funds that lent Saylor billions at 0% interest? They aren't your friends. They are delta hedging. As the stock price collapses, the math of their convertible bond changes. To stay protected, their algorithms are forced to short sell even more MSTR stock. This creates a massive mechanical wave of selling pressure that has nothing to do with Bitcoin's price. It is a ghost in the machine. Phase 3 is the reputation default. It's now 2028. Bitcoin is in a deep bear market. That $1 billion wall of debt we mentioned earlier is now staring the board in the face. The cash reserve is gone. The stock is at a discount, so they can't raise new capital. They only have one choice left. They must sell the Bitcoin. Michael Saylor has famously said there is no second best, but the law doesn't care about philosophy. If they sell 33,000 Bitcoin to pay that bill, it triggers a panic in the global market. The sale crashes the price of Bitcoin, which lowers the value of the company's remaining holdings, which drives the stock price even lower. This is the spiral. Every move to save the company only makes the hole deeper. It is the ultimate financial irony. The very asset Saylor tried to protect becomes the weapon that destroys him. So, is MicroStrategy a digital fortress or a $60 billion grave? For the aspiring entrepreneur, the lesson here is about the nature of leverage. Leverage is a high-octane fuel. It can take you to the moon, or it can turn a small spark into a massive explosion. Michael Saylor has built the most sophisticated financial battery in history. He has built defenses like the PIK Toggle and the ladder debt that no other company has. But he is fighting against the oldest law in the universe: gravity. On January 15, 2026, we will see if the battery can withstand its first real structural test. If the premium holds, the empire continues. If it breaks, we're about to witness the largest forced liquidation in the history of the stock market. The strategy may work for another decade, or it may end in a 21-month countdown to zero. Either way, MicroStrategy has secured its legacy as the ultimate experiment in what happens when you try to bridge the old world of debt with the new world of digital code. The only question is, who will be left standing when the clock hits 12?